our forecast was a monthly inflation rate at close to 3%. So overall, if you look at the trend that inflation rate is following, it is following a declining trend, and that is in line with the central bank's tight monetary policy. So right now it is around 32%. We are expecting a further decline in inflation before it starts going back up through the end of the year. So our guess at this point is inflation rate to go down to around 30%, but end the year with around 32% or so.
Okay, so 32%, that's what you're calling it. The central bank has a year-end target of 31%. In terms of its rate decision, September the 11th is the day that it will meet. Is it going to be 2 percentage points or 3 percentage points?
So that's a tough one, especially after the growth numbers that we got this Monday, because depending on how you interpret the Turkish growth data, I think it should send us signals about what the central bank is going to do. Well, the markets are expecting a rate cut of around 3 percentage points, but I'm on the cautious side because the way I interpret the growth numbers is the following. So we do have a quarterly growth rate of around 1.6 percentage points. That's a very sizable growth rate. On the upside, what we see is that the main driver of growth is the investment component. That's good because as an economist, that's all you want, right? Inflation is suppressed if the growth is coming from the investment component. However, when we look at the subcomponents of investment, all right, so plant and equipment and residential construction increased by about 2.4%. I kind of find it difficult to understand why it came in the second quarter, because that was right after the arrest of Istanbul Mayor Ekrem İmamoğlu and the central bank had to hike rates. So in that high interest rate and high uncertainty environment, it's kind of hard for myself to wrap my head around how come investment appetite increased, but the consumption is declining, which signals that monetary policy is doing what it's supposed to do. The tight monetary policy's impact on household consumption, which is about 65% of total GDP, is finally having an impact. Government spending is declining by 4.4%, but that alone is not enough. So the inventory component apparently is increasing by about 3.5%. Now, an economist can interpret this two ways. One, an accumulation of inventories could be a signal for unsold production. So it could be a signal for slowdown. In that case, central bank could go for all the way to 3 percentage points rate cut on next week's meeting. But on the other hand, an accumulation of inventories together with an increase in investment could mean that the markets are expecting the economy, the growth to pick up. And there's an acceleration of growth. In that case, the central bank has to be cautious and cool down the economy. So I am on this side, and I'm thinking that if the economy is about to grow further in the second half of the year, and given our inflation rate around 32%, the central bank should rather stay on the cautious side and maybe consider a minimal rate cut, if anything, or they should just pass this meeting altogether without any rate cut if they are going to focus on their inflation target.